When it comes to investing, it's very common for people to want to know what lies ahead. That makes sense because we all want to make sure we're investing our money at the right time. But it can be very dangerous because unless you've got a crystal ball, it's very hard to know what the future holds. Every year, Vanguard Investments, one of the largest asset managers in the world, put out a chart on the 30-year performance of all the different assets. In this particular chart from 1987 to 2017, you can see how all the different assets have increased over the long term, but short term they can be quite volatile. Now it's hard to make out the fine print here of all the different world events, but you can see that there can be quite drastic increases and decreases, but long term the trend was up for all the different assets. Dr. Shane Oliver, the chief economist at AMP Capital, has some research on his website about the best performing and worst performing asset classes. You can see here in this table that from year to year, there was no asset class that continually outperformed all the other asset classes, and on the flip side, there was no asset class that continually underperformed either. Taking it a step further, Dr. Oliver had a look at the Australian share market and what would happen if somebody missed the best and worst days over a 22-year period. Now in this particular table, you can see that if somebody stayed invested for the 22 years, their return would have been 11.3% per annum. Going to the far right though, if somebody had missed the 40 best days, their return would have dropped to 3.7%. Alternatively, if they'd been able to avoid the 40 worst days, they would have made 17% per annum. So what does all this mean for you as an investor? Well, first of all, it's important to understand that past performance is no indication of future performance, and it's important to get your own advice about where to invest and when. But in summary, the three key points that I can see is number one, understand short-term volatility and how it could affect you. Number two, diversification can help to smooth out returns. And number three, unless you can predict the future, it's very hard to understand what's going to happen and when. So staying invested can often be the best strategy. Or as they say in financial planning, it's time in the market as opposed to trying to time the market. Hope that helps.